When markets get chaotic, most people stare at the chart and ask one question: where is the price going next? This weekend, I want to ask a different question because it's more important. Is the market functioning normally? Because you can have a rising price in a healthy market, or you can have a rising price in a market where the plumbing is clogged, financing is tight, and the official price starts drifting away from what real buyers and sellers can actually do. Today's briefing is about that plumbing. We'll cover three layers: the scoreboard, why regional silver pricing can diverge; the pipes, how wholesale bullion financing works and how it can break; and the weird part, why 90% constitutional silver can temporarily become a no-bid product for large players. Quick natural disclaimer: I'm not a financial advisor. This is educational commentary based on public information and market mechanics. Precious metals and derivatives are volatile, and nothing here is a recommendation to buy or sell anything. Now, let's set the scene. The scoreboard: one silver, multiple prices. Over the past week, silver pricing has looked less like a single global market and more like several markets arguing with each other. You'll often see a US spot reference price, heavily tied to futures activity, a premium-driven physical retail market, coins and small bars, and a regional benchmark in Asia that reflects local demand, rules, and delivery conditions. When people quote something like "Shanghai is higher than New York," that can happen for several reasons that aren't conspiracy and don't require a single dramatic explanation. Different contract specs, deliverable terms, taxes, and fees, local demand spikes, industrial or investment, capital controls and currency conversion friction, availability of immediate delivery, risk pricing, buyers paying up to secure supply. Think of it like airline tickets. A seat from A to B is not one price. It depends on timing, availability, and restrictions. Silver can behave similarly. And when the gap grows large enough, it creates a powerful incentive. Metal flows towards the highest effective bid, especially if it's deliverable and financeable. That brings us to the real story, not the number on the screen, the ability to finance and deliver the metal, the bullion supply chain. Most people imagine the silver market as miner to mint to you. In reality, the high-volume system looks more like refiner to wholesaler to retailer to end buyer, with banks and credit lines sitting underneath it. Wholesalers don't typically keep tens of millions of dollars idle in cash. They operate on thin margins and large turnover, which means they often rely on revolving credit facilities, inventory financing, and hedging in futures markets to manage price risk. This system works beautifully when prices are stable and credit is cheap, but it has a hidden weakness. When the metal price rises rapidly, a wholesaler's credit line doesn't magically rise in ounces, it rises in dollars, if it rises at all. So even if demand is screaming, the wholesaler's ability to restock can shrink dramatically without anyone going bankrupt in the traditional sense. It's not always insolvency. Often it's a simpler, uglier word: illiquidity, why hedging can become a cash drain. Now add hedging. Many wholesalers hedge inventory by taking futures positions so they aren't wiped out by sudden price moves. In call markets, that's rational, but in fast markets, hedging can create a cash flow problem. A simple illustration: imagine a firm holds physical inventory and sells forward via futures to lock margins. If silver jumps sharply, the futures side can face margin calls even if the physical metal is worth more. Margin calls require cash today, not profit later. So a firm can be right long-term and still lose the short-term liquidity battle. This is why you can see behavior that looks irrational on the surface: dumping inventory quickly, refusing certain buybacks, widening spreads, going no bid on products they're harder to process. Not because silver is unwanted, because time and cash become more valuable than inventory. Which leads us to the headline that confuses almost everyone. Why would large buyers hesitate to bid on 90% silver? The 90% silver paradox, when good silver is inconvenient silver. 90% constitutional silver, older dimes, quarters, half dollars, has two features retail buyers love: it's fractional and it's widely recognized. But refiners and large wholesalers evaluate it through a different lens: processing time and working capital. Most industrial demand wants 0.999 fine silver in consistent formats. Constitutional coin silver is an alloy, silver plus copper, and arrives in mixed conditions. To turn bags of 90% coins into industrial-grade silver, a refiner has to accumulate enough volume, schedule a melt, separate and refine, assay, and settle. That process can take weeks, depending on backlog and logistics. In a normal environment, that's manageable. In a credit squeeze, those weeks are expensive. Here's a fresh example. A wholesaler has a $20 million credit facility. At $25 an ounce, that can finance about 800,000 ounces of silver. At $100 an ounce, that same facility finances only 200,000 ounces. Same credit line, 75% fewer ounces. So even if demand is screaming, the wholesaler's ability to restock can shrink dramatically without anyone going bankrupt in the traditional sense. It's not always insolvency. Often it's a simpler, uglier word, illiquidity, the under-spot confusion, how it can happen. You might hear, secondary silver is trading under spot. That sounds impossible until you remember what spot is. It's a reference price, not a guarantee that every form of silver clears at that price. In real markets, every product clears at spot plus or minus premium or discount plus or minus friction costs. Friction costs include assay risk, processing time, shipping and insurance, financing costs, counterparty risk, and sometimes plain old urgency. If a seller must raise cash quickly, they may accept a lower bid. That doesn't prove silver demand collapsed, it can simply prove someone needed liquidity immediately. And for retail viewers, a safety reminder. If you see too cheap to be true offers, be careful. Cheap means distressed selling, real, or counterfeit or verification risk, also real, or bait pricing that changes after you commit. So the right mindset is not cheap equals jackpot, it's cheap equals investigate, geopolitics, and the risk premium. Now let's address the other force people are watching, geopolitics. I'm not going to do military commentary here, that's not the point. The financial point is simple. When the probability of disruption rises, energy shocks, shipping risks, sanctions, budget expansion, markets often apply a risk premium. Precious metals can benefit from that in two ways: inflation expectations, especially if energy prices rise, and confidence hedging, when investors question currency stability and counterparty chains. But the key word is can. Markets are not linear. Headlines can reverse quickly. So treat geopolitics as a factor that can widen volatility, not as a one-way guarantee. What to watch next week. Instead of predictions, here's a practical checklist of indicators that help you judge whether this is just a fast market or a stressed market. A. Regional premium behavior. Does the Shanghai premium stay elevated or compress? Are export and import flows visibly tightening certain inventories? B. Retail premiums versus spot. Are coins and small bar premiums rising even if spot stalls? That can indicate physical tightness at the consumer level. C. Wholesaler availability. In stock isn't the same as available for immediate delivery. Watch delivery times and limits. D. Volatility and margin conditions. Rising volatility often increases margin requirements. That can pressure leveraged participants and tighten liquidity further. E. Inventory reports and lease rates. Inventory is a lagging indicator, but sharp changes matter. Lease rates, where available, can hint at tightness in lendable metal. Put another way, the chart tells you what happened. The plumbing tells you what might happen next, a grounded way to think about physical metals. If you're considering precious metals at all, a responsible framework is: what role do you want it to play? Hedge, diversification, long-term store of value. How will you store it safely? How liquid does it need to be for your situation? And are you comfortable with volatility and premium swings? And if you're not comfortable answering those questions, that's not a failure. It's a signal to slow down and learn more before making decisions. Also, because scams rise during volatility, we will never ask you to send money to a support desk, a Telegram group, or a random contact claiming to be us. Stick to verified links and reputable counterparties. So the big takeaway from this weekend isn't just silver is up or silver is down. It's that when credit tightens and delivery timelines matter, the market can fragment. The reference price, the regional price, and the real-world retail price can temporarily disagree. And the weirdest headlines, like "no bid on 90% silver," often make more sense when you view them as working capital decisions, not as judgments on silver itself. If this breakdown helped you, hit like, subscribe for more market mechanics briefings, and leave a comment with one useful data point. What premium or discount are you seeing right now on 90% silver and 1-ounce coins where you live? Thanks for watching, and as always, stay skeptical, stay calm, and manage risk first.